Prateek Agarwal, business head and CIO at ASK Investment Managers, joins us in the show right now. Prateek, hi, morning. Just wondering whether the horrors of February and March are behind us, or should we brace ourselves for some more correction in the days to come?
No, so the horrors happened after the budget. So the budget increased cost of capital for investing into equities, and we made a point, I think, on this show as well, that one should have expected around 10%, 11% correction from the highs, given that the globe was looking fine. We have now got that. So if there is a further downtake, it would be an overshoot to our minds. We should consolidate here and maybe look up in line with the earnings growth, a tad lower, just to correct for the valuations. So if one expects 18-19 EPS growth to be around 18%, take away 4-5% of valuation correction, our base case would be expect market to do 12-13% for fiscal 19.
Right. Prateek, what are you making of the story when it comes to the oil and gas sector in lieu of global oil prices rising? It's beneficial for ONGC, but on the flip side, OMCs come under the spotlight on whether or not they can manage their business independently ahead of an all-important election season. We already saw the stocks under pressure yesterday.
Yeah, so we are firmly in the camp that believes that they have got marketing freedom, and it would not get impacted by the elections or anything. So yes, high oil prices, but this that is what the India reform story has been over the past few years. Oil sector reform has been a big part of it. Really don't believe that there would be any going back on that reform story at all. So this is a cheap space to our mind, a very cheap space, and all of these doubts really give a good chance to get in.
Sorry, go ahead.
Would you take a revised call on ONGC and some of the upstream companies? Because if OMCs come under pressure, then there would also be that question mark on whether or not there would be some sort of a revised subsidy burden that the upstream companies may have to share, or is it really a one-on-one correlation for ONGC, and you don't think the government would want to risk revisiting that sort of an arrangement?
So at this juncture, we don't believe there is that risk. One. Second, versus upstream, where the only thing that you are playing is actually the price of the product itself, and that too has been capped in the past as to what an upstream entity can make. The downstream have both the levers, volume increase and margins. So in the oil refining, marketing and upstream pack, we would want to be in the camp of oil refining and marketing rather than upstream oil companies. Because upstream, they are not being able to increase production with any meaningful percentage. In fact, many of the years it may show a decline while their reserves may accrue, but the production doesn't increase. So that's the challenge. And second, medium term outlook on oil is a very, very divided house. We tend to believe that given what is happening with shale, high oil prices are going to be tough to defend. We should expect to see oil fall a bit rather than being where it is. So that again, makes us look more on the refining marketing side rather than the upstream side.
Prateek, PSU banks, or rather I should say even the corporate banks aligned with them, irrespective of how murky the details may be and skeletons still coming out of the closet, would you say that the price damage is overdone now and maybe one should start nibbling in? or is that a sector that now you would completely steer clear from?
So we have been staying clear of this space now for multiple years, and it's almost like a broken record that I've been saying this over past several years. We would have dabbled here over past 7 years for a brief period of 3 to 4 months, and frankly, not made money in any of those three instances where we may have looked at this space. Our fears are one, the stress in the space itself with the changing rules, etc. Two, the competencies, capabilities themselves. Third, the conflict of interest that are existent in a corporate lending kind of a space. So, it is best to stay away. In some cases, yes, the damage may have been overdone, but there, I would believe the investors would need significantly higher degree of comfort, before they can look at investing with any long term in mind. Short period trade is a completely different ball game. Our sense is that this is a very, very attractive space. We have a combination of low penetration, and on the well run private side, so private side is both well run and not so well run. On the well run private side, a multi-year market share gain story as well. So I think it is much more secular to be focused on this space. That's a take, but be with the better run institutions rather than look at the ones which have been impaired.
I also want your perspective on the four-wheeler space. They've had a great year. Do you think the going can still look that strong? And what do you make of the opportunity that there may be in two-wheelers from an upside perspective? Four-wheelers have been there. They've performed. They've delivered to investors. Maybe Tata Motors is an exception, but largely the basket has done well. Do you think there is perhaps a bigger opportunity bias with two-wheelers now?
Okay, so we are positive cars. The penetration in the marketplace is still low. As incomes increase, people will buy more cars. It gives a sense of freedom and a sense of prestige of having arrived in life. So those are things which are very, very human, and as people have the ability to spend, they will buy cars. Two-wheelers are a different ball game. There the penetration levels are significantly higher, and that is why to build a sustained high volume growth story is very difficult unless you get into the lifestyle segment. So we would like players who are focused on lifestyle segment, or players who are less focused on the commuter bikes, 100cc, 125cc, maybe taking the product basket up to a higher cc, more aspirational range. So that's our thought on two-wheeler. We have broadly stayed away from this space, except for maybe having one exposure there.
And another aspect that I want to touch upon is the financial sector. Now, you may be focused on the private banking space, but given the names that have been tainted there, marred by controversy, how do you take the approach towards private banking names? Is it still okay, more money into Kotak as well as HDFC Bank or IndusInd Bank, or are you kind of booking profits because you just think the space is getting a bit murky? Many are calling it an identity crisis. Mr. Vijay Kedia was right here a little while back, and I think he aptly put it as the whole sector going through an identity crisis, so to speak.
So you named the three banks that we are invested in, and those are the banks that we have been invested into for last several years. Apart from these, in the financial space, it's good to be invested into insurance companies, both general and life. There again, penetration levels will allow for significantly longer period of growth and profitable growth as well. On top of it, there are a few NBFCs which are listed and are doing extremely well over past few years. So here again, we are not, trying to find newer names, but we are sticking with the earlier ones which have done very well. In finance, building a credibility is of extreme importance because it's very tough to look into numbers and find out anything, given the fact that the raw material and the finished product both is cash money. So credibility of the management, how they have performed over extremely long periods of time, is extremely important, and very few businesses offer that, and in combination with strong growth. So we are just focused on that space, and we continue to be invested there.
Great chatting with you. Thanks for taking the time out and joining in with your views and opinions on markets and various sectors.